Yes, very good evening.
Good evening, all the members and participants. Today we are organizing VCM on deductions under Chapter 6A. This has been organized by Direct Taxes Committee of ICI, one of the very vibrant committee. Before starting the session, now I request CA Purushottam Khandelwal sir, the Central Council member, to please give his opening remarks.
Good evening, Honorable Central Council Member and Chairman of Direct Tax Committee, C.V. Chitle sir, Faculty Sunil Malu, Rishikesh Wagle, my dear friend Parag Bhai, and all the members. It gives me immense pleasure to be welcome all up in this Direct Tax Committee program organized by this committee for the members, because all the income tax return filing date has been coming near, and so it's very important to know the deduction for individuals. And the Sunil Malu is a very, very brilliant chartered accountant. I know him since long back. So please take the benefit of Sunil Malu, and thank you, Chitle sir, for giving me an opportunity to welcome my member. Thank you, sir. Thank you so much.
Thank you, Purushottam Bhai.
Yes, sir. Thank you, sir.
Rishikesh, please invite Parag Rawal, former Vice Chairman of WRC. Parag Bhai, you are not audible.
Parag bhai, unmute कीजिए.
Hello, hello. Am I audible, sir?
Yes.
Hello.
Yes, now audible.
Yeah. The Honorable Chairman of Direct Taxes Committee, C.A. Chandrasekhar Chitleji, the Central Council member. Hello. Hello.
Yes, sir.
Yes, you are audible. Please proceed.
Yes, okay. Yeah, Honorable Chairman of the Direct Taxes Committee, C.A. Chandrasekhar Chitleji. I'm not audible. Sir, Purushottam is telling that I am audible.
Yes, you are audible.
Yes, audible, sir.
Chitleji, Chitle sir, yeah, you are also audible. Chitle sir, now you can hear me?
Ji? Yes, yes.
Okay.
Yes, you are audible. Please.
Fine. Honorable Chairman of Direct Taxes Committee, Chandrasekhar Chitleji, is Central Council member of our institute from Pune City. Yeah, Honorable Vice Chairman of the Direct Taxes and very good dear friend of mine, C.A. Purushottam Khandelwal ji from Hyderabad, entire team of the Institute Chartered Accountants. Yes, that entire team and entire committee of our institute. I think some noise is distracting us. Isn't it? Some noise is distracting us. Fine. Today is a very important topic we are going to discuss. The topic is the deduction available under section chapter 6A of the Income Tax Act. Very current topic, very recent, very important topic, because in the within a newer future we are going to apply all these provisions in file preparing our returns.
I think except speakers, let others go on mute.
Hello. 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 Am I audible? Hello. Hello, Rishikesh ji, am I audible, Rishikesh ji? Noise is coming, perhaps some disturbing noise is coming. Rishikesh ji, am I audible, Rishikesh ji? Hello, Rishikesh ji.
You are audible.
Yes, sir, you are
requesting
audible.
everybody to go on mute so that you will be more clearly audible.
Okay.
Please proceed.
Yeah, and to discuss all these things, we have a very good C.A. Sunil Malu. Sunil Malu is from Ahmedabad and a very learned speaker. He is a practicing chartered accountant. Ahmedabad. He is a founder partner of Sunil Malu Company. His core areas of practice include corporate consulting and direct tax litigations. For more than a decade, he is into this field. He is a regular contributor of articles which are published in various professional journals, including yes.
कभी आप जो सवेरे नहीं
Sunil
करना
Manuji
चाहते
is a
सकते
regular
हैं
contributor
तब
of
जाके
articles
पूजा कर
which are
रहे
published in
हैं
various professional journals, including CTC.
सब कुछ अगर
He
आज
has
तक
also
पता
delivered number of
लेकिन मैं
lectures
कुछ अच्छा अच्छा प्रोटोकॉल
in several branches of institute. So with this brief introduction, it is my pleasure to introduce before you the today's learned speaker, very good friend of mine in Ahmedabad, and very versatile personality, C.A. Sunil Maluji. Sunil Maluji, you are welcome to this forum, and we are proud that you have joined us, and we are very eager to hear your views.
Thank you, sir, for your kind introductions.
Rishikesh.
Chitreswarji, the Central Council member and Chairman of Direct Tax Committee, to please give his opening remarks.
Thank you, Rishikesh. Friends, Direct Tax Committee has organized this series of webcasts in the month of June for the reason that July is the major due date for non-corporate assessees to furnish return of income, and thereafter immediately the tax audits start. Now they have also started, and we will be furnishing returns of corporate entities or entities under tax audit. Ahead of this particular exercise of doing computation, etc., it would be beneficial if we know the latest provisions of law, what are the common mistakes, what care one has to take. It would be befitting the profession will elevate its own standards when you know if some error has crept in, maybe ahead of your working, you will be able to understand nuances of various aspects relating to computation of income. So one part of computation of income is also understanding what are the deductions available and what are the conditions which are required to be fulfilled. And practically, while computing income and while furnishing ITR, what are the precautions one has to take in respect of claiming those deductions so that these deductions get allowed. Because as you know that under section 80C, maybe you will be getting certain deductions, etc. But in case of, say, repayment of house property loan, you are eligible for deduction. But if such house property is prematurely sold, then that also becomes your income. So while we are particular in claiming deduction under section 80C for repayment of loans, but if the house property is sold prematurely, whatever deductions we have availed in earlier period are exposed to income. This particular aspect is missed. So whenever clients come and meet us, and taking advice for the purpose of computation of capital gain, what should be the component of ready reckoner value, etc. This aspect also should be kept in mind, and that we realize once when we understand these lectures or various salient features are unfolded by the lecturer. While I was discussing this particular concept, my colleague on council, CA Purushottam Khandelwal, a very active member in the council, and whose vision and policies are readily and very fondly listened by the council and also observed. And he is also vice chairman of very two vibrant committees and also doing excellent work in examination committee. So he said that Sunil Manu is very expert in this particular field, and although up till now he has been on the days as far as Ahmedabad and Western region is concerned, he is a young person and a young professional. He would be befitting for the committee and the stakeholders if they listen the thoughts of Sunil Manu on this particular subject. So I am very happy that Sunil has very kindly consented to share his wisdom and knowledge with all of us, and I'm sure with your knowledge sharing, we all would be able to assist clients in saving their taxes by claiming appropriate deductions. Thank you.
Thank you, Chitresh sir, for your kind wisdom. Now I request CS Sunil Malu, our today's learner speaker, to please take charge and carry on the session, please.
Thank you, sir. Good evening. At the start of the session, I would like to thank from the bottom of my heart to the chairman of Direct Tax Committee, Sri Chitale sir, Purushottam Khandelwal sir, Central Council member, Sri Parag Rawalji for kind introduction, and all the team of Direct Tax Committee at ICI for organizing such events for the benefits of the members throughout the country. Sir, allow me to share my screen. I am sharing my screen, and please confirm once the screen is visible. Sir, please confirm my screen is visible.
Gray screen is there.
Yes, sir. Please. Can you confirm, sir? Right now. Thank
Yes,
you.
sir.
Okay. So today we will discuss the basic concepts of deductions under Chapter 6A relating to the particular focus on the non-audit clients, which are basically the individuals and HUFs, for which the return filing deadline we have in the July 2022. So this is the good time to discuss all these things for non-audit assessing perspective. So, what is the scope of Chapter 6A? Chapter 6A is a specific chapter under the Income Tax Act which contains various benefits to the assessee by the government in respect of claim of deductions under the Income Tax Act. This chapter covers the deductions which are to be made in computing the total income. So, basically, we have heard two terms, gross total income and net total income. So the difference between the gross total income and net total income is the deductions which are being covered under Chapter 6A. Chapter 6A basically runs from Section 80A to Section 80VV. It has four parts, Part A, Part B, Part C and Part D. So the Chapter 6A has been divided into various parts based on the types of the deductions. Some deductions are payment linked, some deductions are income linked, and some deductions are investment links. So today we will going to discuss the investment linked deductions which are basically available to the individuals and HUF assessees. First in the series is the Section 80C, which is the mostly known section under the non-auditable category, because this is the main section under which most of the public takes the benefit of some investment, some incentive by the government by making investment in the various specified categories. So Section 80C, as we all know, is the deduction section which is available only to the individuals and HUFs. The maximum limit for deduction under this section is restricted to 1,50,000. One thing we should note that this deduction is available on payment basis. In the year in which we make the payment for a particular item which is specified under this section, then we will only get the deduction under this section. Suppose LIC installment which is getting due in March, but we fail to make the payment and we make payment of the said installment in the month of April, then the benefit of this section cannot be claimed in the March because this is payment linked deduction.
आवाज क्लियर नहीं आ रहा है
Sorry. Am I audible, sir?
Sir, you are audible. There were some disturbances, I guess. You can continue.
Okay,
Yeah,
sir.
you are audible, but some distracting voice is coming, like double voice.
Nee,
Whatever you are
are
speaking,
you?
whatever we are speaking is repeated
Hey.
once again. So I think it is very disturbing sound.
No. If you have joined from two devices, then remove one device because that itself echoes. And other than speaker, let all other participants be on mute mode.
Okay. I have joined from one device only, sir.
करना क्या?
Sir, you can continue.
हाँ,
Ramesh, you are audible.
Yes, sir. So now
And
we
remove
will
all other
discuss.
participants.
So
Yes,
now
sir.
basically we will discuss one by one all the eligible transactions which are specified under section 80C, which is the very basic provision of the chapter 6A. So first in the series is the life insurance premium for any policy. This benefit is available to individual if the payment is made for the life of the assessee, assessee's spouse, or the child of the assessee. And if the payment is being made by the HUF, then the benefit can be available only if the premium is paid for the life of any member of the HUF. Similarly, we have one another concept of deferred annuity. So any sum paid under a contract for a deferred annuity in case of individual, it is allowable only for the individual's spouse, and any of the child. But here a condition has to be kept in mind that contract should not contain an option to receive cash payment in lieu of the annuity. So it has to be a deferred annuity payment, and there should not be an option to receive the cash payment in lieu of such annuity. And if HUF is making such kind of payments, then such payment has to be for the purpose of member of the HUF only. Next transactions which is allowed under ATC is sum deducted from the salary payable to government servant for securing deferred annuity or making provision for his wife or children. Here the qualifying amount is limited to the 20% only. So basically, whenever a sum is deducted from the salary which is payable to a government servant on the basis of deferred annuity, then such claim can be made under ATC subject to a qualifying limit of 20% of the salary. Next transaction is contribution by an individual under the employee provident fund scheme. Whenever an individual is making any investment under the employee provident fund scheme, such investment will be covered under ATC. Next, the contribution to public provident fund account in the name of. As we all know that section 80C, there is two concepts, employee provident fund and another is public provident fund. Employee provident fund can be made only by the salaried persons. So those class of category of persons who are not salaried and self-employed, those persons can make contribution to the public provident fund. Such payments can be made by individuals, can be made by HUF. If the payment is being made by the individuals, then benefit for the same will be allowed only if the payment is made for individuals or his spouse or child of such individuals. And if it is being made by the HUF, then it has to be for any member of the HUF. Contribution by employee provident fund to recognize provident fund. A person who is a salaried person is making a contribution to the recognized provident fund. Then also such employee's contribution will be covered under ATC. Similar way, employee if it is making contribution to approved superannuation fund. So basically these all are the employment based benefits which are invested or make payment by the employees for the purpose of their future, either in form of public provident fund, either in form of recognized provident fund or employers approved superannuation fund. Then all such payments will be covered for the purpose of ATC as a deduction under chapter 6A. This is very interesting point to be kept in mind for the Sukanya Smriddhi account scheme, which is basically an investment scheme for a girl child. So technically, subscription to any notified security or notified deposit scheme of central government. For this purpose, central government has notified one scheme which is named Sukanya Samriddhi Scheme, Wide Notification number 9/2015. Here under this notification, central government has made an announcement that if a person is having a girl child or a guardian who is maintaining a girl child, then they can make investment in the name of such girl child under the scheme of Sukanya Samriddhi account, and all such payments will be covered under ATC. Next in the series is the subscription to the notified saving certificates, we commonly call as National Saving Certificate, NSC. All the NSC bonds are covered under ATC. Contribution for participation in unit linked insurance plan of UTI. As we all know, UTI is having various insurance plans which are linked with the units. So a person can take insurance through UTI also, and in if to notified unit link insurance plan of LIC mutual funds, then also such payments or such investment will be covered under ATC. Next is the subscription to notified deposit scheme or notified pension fund set up by National Housing Fund. Various national housing banks are maintaining a pension fund for the purpose of some home loan scheme or national housing tax saving schemes. So to fund all such kinds of home loans, these banks gathers deposit from public in form of issuance of some certificates, and if a person is making investment in those schemes, then also eligible for ATC. This is very important and very relevant in the recent time, because as we all know, the cost of education is going higher and higher. So to cover such and to incentivize the people to make their childs educated, government has considered tuition fees also as eligible transactions under ATC. But here we need to keep in mind that only the tuition fee, which is basically the school fee or college fee, is covered here only. Some charges are being collected by the schools or college apart from the tuition fee or school fee name, such as development fee or donation. Then we need to keep in mind that all those natures of payment will not be allowable under ATC. So we need to make a clear category whether the payment which is being made by the assessee is falling within the criteria of tuition fee. The second thing we need to keep in mind in here is that this benefit is available only to the individuals, not to the HUF. Then it has to be paid to a university, college, school or other education institute situated in India. This is also very important, that tuition fee benefit for ATC is available only if the institute where the child is getting the education must be situated in India. Suppose we are sending our kids to study abroad, then the payment of school fee or college fee for the abroad universities will not be covered under the tuition fee criteria. And here also the ceiling limit of maximum 2 children are covered. So if some person is having more than 2 children, then the limitation will be there to cover tuition fee of such children only up to 2. Then next payment which is eligible under ATC is for purchase or construction of residential house property. As sir has also mentioned in the opening remark, that whenever we make purchase or construction of residential house property by taking some loans from the authorized institutes, then the payment of principal amount of loan is covered under ATC. We have to segregate all the EMI payment into 2 parts. What is the principal part and other is the interest part. Interest part benefit can be available under section 24B of the House Property Act, but the principal part will be covered under section ATC. And one more thing we need to keep in mind for this particular types of transactions, that whenever we purchase a property, even from the self funds, we are not taking any bank loan or any loan, so the question of principal does not arise. In such case also one can take benefit for the stamp duty and registration fee paid for purchase of such kind of house properties. Next transaction is subscription to notified schemes of public sector company engaged in providing of long-term finance for purchase or construction of houses in India for residential purpose. Authority constituted under any law for satisfying need for housing accommodation. So if there is a notified scheme whereby the counterparty is providing long-term finance for purchase or construction of houses in India for residential purpose, and the assessee is making investment in such types of scheme, then those notified scheme will be covered under ATC. Next is the sum paid toward notified annuity plan of LIC or any other issuers. This is very important in the recent time, as we have observed that the attention of the public or interest of the public is diverted mostly towards the mutual funds investment. So subscription to any units of mutual funds which are notified under section 1023D and which is also equity linked saving scheme, then all such investment will be covered under ATC. So suppose a person is willing to make investment into mutual fund, then he need to verify that whether the investment scheme in which he is making the investment is basically the equity linked saving scheme or not. And for that he need to confirm that at least 65% or more of the value of the scheme is getting in turn invested into the equity market. And if all those criteria are fulfilled, then our mutual fund investment will be covered under ATC. Similarly, a contribution by an individual to any pension fund set up by any mutual fund which is referred in 1023C, 1023D or by a UTI, all these types of payment will be covered under ATC. Under ATC, one can also take benefit of term deposit for a fixed period of not less than 5 years with a scheduled bank, which is in accordance with the scheme framed and notified. So a person can take benefit and can make investment into the bank FDs, but he has to make sure that the scheme is falling under the notified scheme for this purpose. Notified bonds of NABARD also covered under ATC. Deposit in an account under the Senior Citizen Saving Scheme Rules 2004. Suppose an assessee is a senior citizen, he want to make and for senior citizens government has ruled out some specific schemes. One of such scheme is Senior Citizen Saving Scheme Rules 2004, and a person is making an account under that scheme and making investment in that account, then such investment will be covered under ATC. Similarly, 5-year term deposit in an account under the post office time deposit rule is also covered under ATC. Contribution to Tier 2 NPS account by central government employees. So basically we have gone through all the basic transactions of specified category investment under ATC. Here the purpose of government is to promote the savings amongst the taxpayer by way of incentivizing such saving in form of some tax reliefs. Suppose all these benefits are not given to the assessee, then what will happen that he will not incline to make his income into the saving. These types of investments gives two benefit to the assessee. One is the saving for future, another is securing against the risk of the life, etc. and third is also tax savings. While ATC, apparently all the insurance transactions are covered, but there is some ineligible insurance also which we need to take care. If the assessee is taking such kinds of insurance, then no deduction under ATC will be available, and only category under this is if the payment for premium is in excess of 10% of actual capital sum insured. For example, the sum insured is rupees 1 crore and assessee has opted for the premium for 5 years only, and the per year premium comes to 12 lakh, 13 lakh rupees. If we work out the percentage of premium vis-a-vis the total actual sum insured, then this will works out to more than 10%. And all those cases where the premium paid by the assessee is more than 10% of the actual capital sum insured, then such transactions will be ineligible for the purpose of section ATC. Next important section is deductions under section 80 CCC. Here the transactions of contribution to certain specified pension fund of LIC are covered. This is also included in the overall limit of 1,50,000. There are certain sections ATC, CCC and CCD. All these three sections combined together, there is an overall capping of maximum deductions limit of 1,50,000 that we will discuss in the coming slides. This is very important aspect of our presentation. Apart from ATC, there is a section called ATCCD, and ATCCD section is all about the pension plans or savings for the future in form of investment in the pension plans. So how a person can get tax benefit by saving for his future under the pension? We have section 80 CCD, which is divided into three parts: 80 CCD subsection 1, subsection 1B and subsection 2. So nuances of all these three subsections need to be carefully understood, carefully examined by us, so that we can advise our clients properly on these aspects. First subsection is section 80 CCD 1, which is basically contribution by an individuals. This applicable to all individuals, whether he is salaried or self-employed. So now the government has also provided that a person who is self-employed can also plan for his pension. It is not limited to the salaried class of person. So this benefit is available irrespective of the fact that whether the employee is salaried or self-employed. The eligible payment under these sections are for deductions of amount paid deposited into the pension scheme of central government. What we need to take care is the investment or payments must be for the approved scheme of central government. No other pension plan are covered under here. And maximum ceiling limit under 80 CCD 1 is in two parts. First part is if the person is salaried, then it is limited to 10% of his salary. If the person is self-employed, then it is limited to 20% of his gross total income. Again, this is overall subject to the overall limit of 1,50,000. So if a person has already utilized the limit of 1,50,000 under 80C, then he will not be allowed any further benefit under 80 CCD subsection 1. And if there is some space in that limit, then those can be utilized and by making certain pension investment under this section. So here we need to keep in mind two limits. First is the 10% for salaried class and 20% of the GTI for the self-employed class. Next subsection of this section is section 80 CCD 1B, contribution by an individual. This is applicable to also all individuals, whether salaried or self-employed. Here the eligible payments are for deductions of amount paid or deposited into pension scheme of government. Maximum ceiling limit here given is additional deduction of 50,000. No deduction allowable if some already covered under 80 CCD. So this 50,000 is an additional limit over and above limit of 1,50,000. Third part of this section is 80 CCD subsection 2. This is applicable to all salaried individuals. This is very specific section. This is applicable only to the salaried class of persons. Self-employed persons are not covered in these sections. What are the eligible payments? Payment by employer toward pension scheme of central government. And what is the maximum ceiling limit under this particular subsection? It is 14% of salary if the person is central government or state government employee, and 10% of the salary in case of other employers. This section is in addition to section 80 CCE because this subsections cover the contribution by the employer. So benefit of these sections is over and above the limit of 1,50,000. 1,50,000 benefit is restricted and combined only for the payments which are being made by the assessee. Here, who is making the payment? Payment are being made by the employer. Therefore, the limit of this subsection is over and above the limit of 1,50,000 under 80 CCE. Now, this is very important aspect of the pension scheme. Effect of withdrawal from the national pension scheme. In all the previous three slides, we have learned for the benefit when we make investment into the national pension scheme. Now, what will be the tax effect if the amount is withdrawn from the national pension schemes? We have two sections, section 10(12)A, section 10(12)B. First section covers all the cases where the NPS account is closed or opted out from the pension scheme. So in those cases, 100% withdrawal will be done. Account will be closed, and under that situation, 60% of the withdrawal amount is exempt, 40% is taxable as a general rule. However, with effect from assessment year 17-18, the whole amount will be exempt if it is received by the nominee on death of the assessee. So after assessment year 17-18, for withdrawal from the National Pension Scheme on account of death of the assessee and amount is received by the nominee, then 100% will be exempt, otherwise 60% will be exempt and 40% will be taxable on closure of the pension scheme account. And sometime the assessee may make some partial withdrawals from the NPS account. He is not closing his account, but on need basis he is withdrawing some money. So in those cases, partial withdrawal from NPS shall be exempt to the extent of 25% of the amount of contributions made by the employee. If the withdrawal is beyond 25%, then the same will be taxable. This is also very popular provisions of Chapter 6A, Section 80D. As we all know, Section 80D covers the instances of health insurance, which we popularly call as mediclaims. Here we will discuss the basics of Section 80D. It is available to individual and HUFs. This covers the amount paid to any insurer, be it government or a private. It has to be an insurer registered under the IRDA. To keep in force an insurance on the health of specified persons. Who are the specified persons that we will discuss? In case of individuals, the specified person under this section can be either himself, his spouse, or dependent children or dependent parents. And if the assessee is an HUF, then all members of the HUF will be covered as specified persons. What is the quantum of deductions under this section? We will discuss in the next slide. Before that, I would like to highlight one more point. Additional deduction under this section is available for amount of rupees 5,000 under the head preventive health checkup. As we all know, it is said that prevention is better than cure. So, Section 80D, Mediclaim, all this comes into effect only when there is some hospitalization requirement. Government has promoted the assessee to take preventive health care, and for that a deduction of 5,000 under this section is available. And important fact is that this payment of 5,000 can also be made in cash. Suppose a person is visiting hospital every 2-3 months, making payment for visit charges of 1,000 rupees in cash, and generally these types of small payments are being made in cash only. So even the preventive health payment can be made in cash. Here we will discuss the ceiling limits under Section 80D, and for that I have divided the situations into 3 parts. First is ceiling limit for individuals, second one is for HUFs, and third important case is what is the benefit under this section when no mediclaim is taken. That is the third category. For individuals, benefit of this section is available up to rupees 25,000 if the mediclaim is taken for self, spouse or dependent children. All these 3 category, total combined premium amount is available for rupees 25,000. And if there is if the specified person is a senior citizen, either the assessee himself or his spouse is a senior citizen, then this limit will be increased to 50,000 rupees. And additional limit under this section has been given if the mediclaim is taken for the parents. Additional benefit of 25,000 will be generally available, and if the parents are senior citizen, then 50,000 benefit will be available. So we have in general 2 limits under these sections. For self, spouse and children 25,000, and for parents additional 25,000. And in any of the category, if someone is senior citizen, then the limit will be increased to 50,000 respectively. For HUF also the basic limit is 25,000. If the specified person is a senior citizen, then the limit will be increased to 50,000. Third category is a very interesting category. Government has anticipated cases of benefit to the assessee where no mediclaim is taken, and if there is no mediclaim taken, still assessee can claim benefit of these sections under this particular condition, which is within overall limit, deduction allowable up to rupees 50,000 towards medical expenditure incurred on the health of a specified person, provided such person is a senior citizen and no health insurance is taken. Suppose a senior citizen expenses has been incurred, actual expense has to be incurred, number 1. Second, it is has to be incurred for the senior citizen. And third condition is no health insurance is taken. Then benefit up to 50,000 can be claimed despite the fact no insurance was taken. And this 50,000 is included in the overall limit of this section. For treatment of disabled dependent and for disabled assessee, we have two sections called section 80DD and 80U. 80DD is applicable on the medical treatment of disabled dependent, and section 80U is available when the assessee himself is a subject to disability. This section is applicable to the disabled dependent, and 80U is available to the disabled individuals. And benefit under this section is available up to 75,000 in general cases, and if the case falls under the severe disability, then the limit will be increased to 1,25,000. And no double deductions can be claimed under both the sections. Suppose a person has already claimed deduction under 80U in his own case, then the dependent relative cannot claim under 80DD. Here the dependent means in case of individuals, the spouse, children, parents, brothers and sisters of the individuals. So here the definition of dependent is given in a expansive mode, where the brothers and sisters are also included into the definition. We have section 80DDB, medical treatment for the specified diseases. A lot of diseases are specified under a rule which is covered under 80DDB, and if the expenses are incurred for treatment of those diseases, then benefit can be taken under 80DDB. For individuals, here also the scope is expanded one. It covers assessee himself, his spouse, children, parents, brothers and sisters. So specified diseases cases, a person can claim benefit even for his brother, sister also. For HUF, as we all know, all the member of the HUFs, and the ceiling limit under this section is normally rupees 40,000, and if the person is a senior citizen, then it will be increased to 1 lakh rupees. Education is very important, and to promote the education, government has also provided for section 80E. This section covers the interest payment on loan taken for higher education of an individual or his relative. Suppose an individual is incurring expense for himself or his relative's higher education, and for this he is taking some loan and paying the interest, then he can claim benefit of the interest paid on such loans under section 80E. For this, few conditions need to be taken care. First one is, it has to be from the financial institute / approved charitable institutes. Personal loans are not covered under this section, that we need to take care. The amount of interest paid during the initial year, that is the year in which the loan is taken, and 7 immediately succeeding assessment year, or until the interest is paid in full, it is eligible for deductions. Here the relative means relative in relation to an individual, means spouse and children of the individual, or the student for whom the individual is a legal guardian. Here the benefit can be claimed if the relative is spouse or children, or even the legal guardian also can claim benefit of the interest paid for the education loan for the student. Here I have tried to make some comparison between the 3 sections of the Income Tax Act, which are very interconnected. Section 80EE, 80EA and 80EEB. So first of all, we will discuss that in which class section 80EE is applicable. This is applicable on the interest on loan taken for purchase of residential house. Section 80EEA also applicable for the interest on loan taken for the house property. But there is little difference under both the sections that we will discuss one by one. And the third section 80EEB is for the interest deductions for the electric vehicles. As we all know, now the focus is shifting from the normal traditional fuel vehicle to the electric vehicles. And to promote the electric vehicles, government has provided for benefit under 80EEB. For 80EE and EEA, the loan taken from financial institutes or housing finance company are covered. Time limit for section of loan. For this section 80EE has to be between 1st of April 2016 to 31st of March 2017. So in the financial year 16-17, if the sanction is made, then that loan will be covered under 80EE. And if the sanction date is falling between 1/4/2019 to 31st March 22, then the interest benefit will be given under 80EEA. For 80EE, the value of house property has to be up to 50 lakh rupees. The value of loan has to be up to 35 lakh rupees. And there is an additional condition attached to the section 80EE that taxpayer should not be owning any residential house property on the date of sanction of loan. So basically the 80EE benefit are available only for the first house. Deductions of interest under 24B, as we all know, is up to 2 lakh rupees. And this benefit of 80EE and 80EEA are over and above the benefit which is available under 24B. Limit of deductions in addition to deduction 24B under these sections are 50,000 for 80EE and 1,50,000 for 80EEA. So at present, the 80EA sections, the date has been expired recently, 31st March 22. So all the loans which have been sanctioned between 1/4/2019 to 31st March 22 will be eligible for additional benefit of 1,50,000 rupees for the interest on home loan. The third section as we are discussing here is 80EB, which is for the interest deduction for electric vehicle. For this, we have to take loan from financial institute or non-banking financial company. Here, even from the loan from NBFC are also covered. The sanction date must be between 1st of April 2019 to 31st March 2023. There is no ceiling limit on the amount of the proper vehicle which is being purchased. Only condition attached is the maximum benefit under the section 80EB for the interest on the vehicle loan, electric vehicle loan, is limited to 1,50,000. So section 80E and EEA are over and above section 24B, which is benefit for the interest on home loan. If the sanction is made between 16-17, additional benefit of 50,000 can be continued to be carried till the loan is fully repaid. Similarly, if the sanction is made between 2019 to 2022, the interest benefit of 1,50,000 can be claimed in the upcoming year also till the year loan is fully repaid. Now we will discuss deductions under section 80G. 80G basically covers the claims of donations to charitable and religious institutes. Only condition which is relevant here is that for claim of donation above rupees 2,000, one has to be made in mode other than cash. We have to make the donation exceeding rupees 2,000 by account fee check or some online banking channel only for claim of deduction under section 80G. 80G sections is divided into 4 parts. It has given specified various transactions, various categories into 4 categories. If the transaction is covered under the first category, which is the donation with 100% deductions without any qualifying limit. So if the transaction is covered under this category, entire amount of donation will be available for the deductions without any other conditions. Second is donation with 50% deductions without any qualifying limit. Under this category, 50% amount of donation will be allowed as deductions. The third and fourth category are similar to first and second, but subject to a extra condition of a ceiling limit. Donation to certain funds are eligible for 100% deductions subject to 10% of the adjusted gross total income. Here the donations are eligible for 100%, but again we need to compare the amount of donation with the 10% of the adjusted gross total income, and it will be limited, restricted to 10% of the adjusted GTI. Under the fourth category, donation to certain funds are eligible for 50% deductions subject to 10% of the adjusted GTI. For section 80G, we have heard the word adjusted GTI. Now we will discuss what the term adjusted gross total income means. Gross total income, which is technically the sum of income under all the heads, reduced by aggregate of the following. We need to remove all these items from the gross total income, then we will derive the amount of adjusted gross total income. First one we need to remove is the amount deductible under section 80 CCC to 80 U, but not 80 G. Then we need to take out the amount of exempt income out of our gross total income. Amounts of long-term capital gain also need to be removed. Then income referred in section 115A, 150AB, 115AC, AD and D. All these 5 sections, if the income is belonging to these sections, then we need to remove from the gross total income. And if we remove all these 4 category of transactions from our gross total income, then we will get the amount of adjusted gross total income. And we need to work out 10% of that adjusted gross total income for the purpose of category 3 and 4 of the ATG. Next section is ATGG, deductions in respect of rent paid. Rent paid for the furnished unfurnished residential accommodation is covered under section 80GG. The ceiling limit is lower of the 3 points. Rent paid in excess of 10% of total income, 25% of the total income, or 5,000 per month. We need to work out A, B and C, all the 3 figures. Then the benefit will be restricted to the lowest of the 3 figures. Total income is equal to gross total income minus long-term capital gain, short-term capital gain under 111A, deductions under section 80C to 80U, and income under 115A. So these terms need to be kept in mind while working out the ceiling limits, because here the word written is 25% of the total income. We cannot take the total income of from all the sources. Here the total income is defined to mean something, and when a term is defined to mean something, then we need to restrict the meaning of that item subject to that definition only. So total income here is defined to be gross total income minus long-term capital gains, short-term capital gains under section 111A, deductions under section 80C to 80U, other than of course this section, and income under section 115A. And one more condition that we need to take care for this section 80GG is it is available for deductions only to individuals not having HRA. Suppose a person is already having an HRA and claiming under the salary head, then he will not be further benefit, then he will not be eligible for the further benefit under section 80GG. Now this section is very important. Section 80JJAA, deductions in respect of employment of new employees. As we all know, government has focused for the promotion of the employment amongst the promotion of the employment throughout the country, and for incentivize the employment, for incentivize the new recruitments, government has provided a sections 80JJAA, which is deduction in respect of new employees. This section is very complicated, so I have tried to cut short the section and make it simpler by way of this flow chart. Section 80JJAA. So deduction is available for a period of 3 years. As far as the applicability is concerned, it is applicable to all the assessee having the business income and all the assessee who are liable for tax audit. So these are the 2 classes of assessee. 2 conditions attached for the applicability of these sections. First is assessee must be having a business income, and second condition is he must be liable for tax audit under 44AB. If all these 2 conditions are fulfilled, then this section will be applicable. Deduction is available for a period of 3 years. The quantum of deduction is 30% of the additional employee cost. Additional employee cost is defined under these sections. For example, additional employee cost under these sections works out to ₹1 crore rupees. Then deductions under these sections will be for the 3 years and 30% for each year. So benefit for the year 1 will be 30 lakh rupees, year 2 again 30 lakh, and year 3 again 30 lakhs. So for new employees, if a person is incurring a total cost salary expense of 1 crore rupees, he will get deductions of 1 crore 90 lakhs over a period of 3 years. So this is very good incentive one should take. Additional employee cost has been defined under these sections. It covers the emoluments paid to additional employees. Emoluments has been defined to mean salary paid or payable to an employee but it exclude pension oblique any other contribution by the assessee for the benefit of employee and lump sum payment at the time of retirement. An additional employee has been defined also. There are certain conditions which we need to take care for claiming these deductions. Additional employee means an employee employed during the current year, due to which net total number of employee has been increased from last year. So we need to compare total head count of our employee from start of the year to end of the year, and there is positive increase, then it will be considered as additional employees. For claim of these sections, the employee with salary greater than 25,000 will not be considered. So we can take benefit of these sections for those employee whose salary is up to 25,000 per month. For claim of this section, employee must be employed at least for 240 days during the year. So if we are engaging someone in the month of January, February or March, which will be technically less than 240 days, then those employees will not be covered under this section. Employee for whom entire pension contribution is being paid by the government will be disqualified. So pension contribution has to be paid by the employer. Employee who does not participate in the recognized provident fund. For claim of this section, the employee must be participant of the recognized provident fund. He must be registered under the PF Act. Emolument are paid otherwise than by way of account fee check. Suppose salary is being paid in cash, then such payment will not be covered for benefit under 80JJAA. For section 80JJAA, no deduction will be available if the deduction is being claimed on account of splitting up or reconstruction of the existing business. If the benefit of deduction is being claimed on account of transfer of the business, if the business is acquired by the assessee by way of transfer from other person or as a result of business reorganization. So technically the splitting up, reconstruction of the existing business, reorganization of business, transfer of business will not be qualified under this section. And for claim of this section, the assessee need to take a audit report in form 10D from a chartered accountant and that report to be furnished before the date referred in section 44AB. So the audit report has to be furnished along with the tax audit report. And to explain the provision of these sections, I would like to explain the same with the practical example also from the Excel chart. So this is a real life example of the claim of this particular section, because this is very complicated sections. So to simplify the same, I have taken a real life example. So here the basic information is like that: name of organization is XYZ Limited, address is so and so, PAN number, and assessment year is 2021, which was ended on 31st March 2020. So here we need to answer 5-6 questions for determining the fact that whether the assessee will be eligible or not. And once we put the answer to these 5-6 queries in these boxes, then okay, let me check, sir. Now it's showing. Sir, can you confirm? Yes, sir. Yes.
Yes, sir.
Yes. This Excel sheet is a real life example of deduction under 80JJAA for new employees. Suppose name of the organization is XYZ Limited, address and PAN number is so and so, and we are working this for assessment year 2021, which has ended on the 31st March 2020. Then we need to answer 3-4 questions which will in turn give us the result that whether the deduction 80JJAA is available or not. So first question is whether the assessee is subject to tax audit, either yes or no. Suppose he is not subject to tax audit, then the result will be that he is not eligible for the 80JJAA. So here we will select yes. Then next question is nature of business. Here two options are given. It is regular or seasonal. Then we have to ask the assessee that it is a restructured entity or a regular going concern entity. Then nature of activities which is being carried out by the assessee. Is it a business or a profession? So if it is a professional firm, then benefit of this section is not available. So it has to be a business concern. And here we need to give certain figures relating to the number of employees. Employees at the beginning of the year 970, new employee added 346, employees which are terminated during the year 270. So total number of employee after making plus and minus at the year end works out to 1046. So effectively there is increase of 76 persons from 970 at the opening, 1046 are at the closing of the year. So we can take benefit of this section for those 76 employees. And how to work out that benefit, which is also in the given chart. Suppose the date of joining of employee for the first serial number is 1/4/2019 and he is continuing throughout the year till 31st March 2020 he is there. So total number of days he is worked for is exceeding 240 days, which is one of the condition. Second condition is whether he is participating in the provident fund. He is yes, registered under the PF. Then this is the amount of salary that we have paid to him throughout the year, 93,000. Per month divided by 12 will be 7,600. It is paid by banking mode. And if all these conditions are fulfilled, then we can get result here that yes, this person is eligible for the 80JJAA. And if it is eligible, then every year 30% benefit will be available to the employer. So against a salary of 93,000, additional benefit of 84,000 in 3 years will be available. Similar exercise we need to carry out for all of the employees. Suppose, for example, at serial number 2, employee is working only for the 91 days. He has joined the organization on the 1st of January. So the total number of working days working with the organization are 91, which is less than 240. So here that person will be ineligible for the claim of the benefit. In example number 5, the total salary of that person is 8,50,000 for the year, and monthly salary will work out to 70,000. And such a salary is more than 25,000 limit, then the benefit will not be available. So we need to carry out the analysis for each and every employees for the purpose of this deductions. So this is very important section, and lot of employees have taken benefit of these sections. And in day-to-day life, we also see that every year the growing organizations are increasing their workforce. So therefore, this can be an important benefit for such kinds of organizations. Next sections are 80, TTA and TTB. These are the benefit on the interest incomes. 80 TTA section is available deduction in respect of interest on the saving bank account deposits. Whatever balance which is laying in saving bank account of us, we can claim benefit of section 80 TTA. This is applicable to individuals and HUFs, but other than senior citizens. Because for senior citizens, we have another sections that we will discuss after this. And deductions allowed up to 100% of the amount of such income, subject to maximum of 10,000 rupees. So all the individuals and HUFs who are having saving bank account and they are earning interest income from those saving account, the income up to rupees 10,000 will be deductible under 80 TTA. And for senior citizen, we have a separate section 80 TTB, which covers the interest on the deposit in case of senior citizens. It is applicable only to senior citizens, and 100% of the amount of such income subject to maximum amount of 50,000 rupees. So if senior citizen is earning interest income from the saving bank accounts, then the benefit of section is up to 50,000 and 10,000 is for the non-senior citizens. Section 80 QQB and RRB. These are basically the royalty income deductions. Deductions in respect of royalty income of authors of certain specified category of books other than the textbook. Suppose a person is authoring a book and the book is published and he is earning the royalty income out of the book income. Then he will be allowed exemptions under 80 QQB for list of the following. First is in case of lump sum payment, amount of royalty subject to maximum of 3 lakh rupees. So if the person is receiving a lump sum payment for the royalty, then up to 3 lakh rupees deductions can be claimed under 80 QQB. And in all other cases, amount of such income subject to a maximum of 15% of the value of book sold during the previous year. So if the royalty is linked with the sale value of the books, then in those cases 15% can be claimed under 80 QQB. These are non-traditional sections applicable in the very few cases, but we need to check if the assessee is an author, then those kind of sections and benefits should be taken. Next section is 80 RRB, royalty on patent registered on or after 1/4/2003. Suppose a person has done some research and the research has been registered under the Patent Act. And if some third party are using that patent or using that research technology, he may be in receipt of the royalty income. And such category of cases, royalty income subject to 3 lakh rupees is totally exempt under 80 RRB. So basically, till now we have explained and discussed the sections of chapter 6A. Now, along with this is also very relevant for the non-audit cases, July return filing season, that government has given an alternate taxation regime also. So now the assessee has two options, either to go for the regular traditional mode by claiming the deductions under chapter 6A, and another is the alternate regime which is given after assessment year 2021. So we will shortly discuss both the regimes, so which will make the analysis and impact of chapter 6A deductions very clear. So this new alternate regime is effective from assessment year 21-22. Individuals and HUFs shall have choice of old versus new. This is applicable to all the individuals, HUF, irrespective of act, whether they are resident as well as non-resident. Rebate can continue to be claimed. Special rate income will continue to be the special rate, irrespective of the old/new regimes, because both the regimes shall have a different slab rates only. The difference is only in the slab rate. There is no difference in the special rate income. For example, section 111A, short-term capital gain from the listed security, is taxable at 15%. Same will continue to be taxable under 15% either of the regimes. Similarly, surcharge will also continue to apply as per the normal rates. So here is the comparison of the old regime versus new regimes. Under the old regimes, there are 4 slabs up to 2.5 lakhs, no tax rate. From 2.5 to 5 lakhs, 5% tax rate is there. Income falling 5 lakh to 10 lakh, 20% tax rate, and exceeding 10 lakh, the tax rate is 30%. Under this mechanism, as we all know, the slab rate are on the net income, and that net income is derived after the claim of deductions under chapter 6A. Alternatively, government has also given an option to the persons who are not making any investment or any savings under chapter 6A to opt for the new regimes, which is basically applicable from assessment year 21-22, applicable to all the individuals and HUF. Here the 8 slab rates are given, up to 2.5 lakh, no tax rate, 2.5 to 3 lakh, and 3 lakh to 5 lakh rupees. Basically this 2.5 lakh slab is subject to 5% tax rate. From 5 lakh to 7.5 lakh, 10% tax rate is given. 7.5 lakh to 10 lakh, 15% tax rate. This way, every 2.5 lakh increase, there is tax rate increase of 5%, starting from 5% to maximum rate of 30%. So old versus new tax regime, how to exercise the option. Here the distinction has been made into two categories. A person is having either non-business or non-professional cases. That is category number 1, and business professional cases are category number 2. So if a person is a salaried person, not subject to any business or profession, then he can choose this option old versus new every year before filing the return. He has full freedom to verify whether option A is beneficial, old regime is beneficial or new regime is beneficial, and he can make choice every year. But this is not the case with the person who is engaged into a business or profession. For those persons who are engaged into business profession, they need to make a call for once. Either they want to go as per the old regime or as per the new regime. So a person need to make an sensitive analysis that which will be the beneficial regime over a long run. And suppose a person is opting for the new regime, then he has to file a form 10E. As I said, the assessee opting for the new regime having business profession can opt for the new regime only for once, and same will be applicable for all the coming assessment years. However, special one-time option has been given to a person to withdraw from the new scheme and come back to the old regime. And if we are selecting for the new regime, then in the return filing there is an option, a specific question is being asked whether you are filing this return under old regime or new regime. We need to select that particular option, and if the person is subject to business profession, then also he need to furnish the acknowledgement number of filing of form 10 IE, and it need to be quoted into the ITR. This is the extract from the ITR forms that we are required to file, and there is a specific question as we see in the filing status slab, point number B. Are you opting for the new tax regime under 115B AC? Yes / no. So here assessee make two choice and intimate to the department in his return itself. There's whether we are going for new regime or old regime. So this is the disclosure requirement in the ITR. And if the person is subject to business and profession and he is opting for this scheme by selecting this yes button, then he need to also furnish the date of filing form 10 IE with acknowledgement number. And this is the basic content of form 10 IE which is required to be filed. This is very simple form. Here the assessee only need to give his name, address, PAN number and select the assessment year for which he wished to obtain for the new regime. But what is the difference between the old regime and new regime? We have discussed in terms of the slab and tax rate. The government has given the benefit of lower tax rate, lower tax slabs under the new regime, but at a cost of something. And what is that something? That we will discuss here. Under the new regime, government has taken back certain exemptions, deductions, which are not to be allowed to the assessee. The list is given in the next slide. No brought forward business losses or depreciation if such loss or depreciation is attributable to any of the deductions which are not allowed under the new regime. So that kind of loss or depreciation will not be allowed to be carried forward. Necessary adjustment for the same need to be made into the cost of the capital asset under the scheduled depreciation. And further, no additional depreciation to be allowed under the new regimes. So basically these are the three benefits which have been taken back by the government. First one is, under the new regime certain exemption deductions will not be allowed. Second is, set off of brought forward losses and carry forward of depreciation will not be allowed. And third is, the additional depreciation to the manufacturing entity will not be allowed under the new regimes. Now these are the list of benefits which will not be allowed under the new regimes. And major part of the benefits are deductions under chapter 6A. These are all the deductions that we have discussed in our previous slides, running from 80C to 80G, 80IA, everything. So all these benefits will not be available to the assessee if he is opting for the new regimes. Similarly, house rent allowance, HRA, home loan interest 24B, standard deductions, leave travel allowance, deductions for donation on scientific research, allowance under section 1014, deductions for employment allowance, employment and professional tax, depreciation, additional depreciation, then exemptions for SAGE unit under 10AA and section 57 2A. Family pension deductions is also not available under the new schemes. But there are some benefits which are still available under the new scheme. Certain important benefits are continued to be allowed under the new schemes. Those benefits are section 10, subsection 10, section 1010A, 1010AA, 10B, 1010D. All these sections are basically the exemptions which are available in respect of the superannuations, gratuity, then insurance receipts on maturity of the insurance that we received under 10D. So all these types of benefits are still there. These are not to be withdrawn under the new regimes. Then section 80 CCD subsection 2, as we discussed, this additional benefit of rupees 50,000 can still be claimed. 80 JJAA, the deductions that we discussed for the new employment, that benefit is still available under the new regime as well. Section 80 LA, Rule 3, free meals up to rupees 50. So these are the specific benefits which will be available under the new regime as well. So basically, to sum up our session, we have discussed various provisions of section chapter 6A running from section 80C to 80U. All the benefits have been discussed in brief, discussing the subject matter, under what circumstances are covered, what is the ceiling limit, what are the basic conditions to be taken care. At the same time, we also discuss the new versus old regimes. We also discuss the new employment benefit under 80 JJAA. So we can take the questions with the permission of the chair, sir.
Yes, sir. Kindly proceed.
Yes, sir. So I will check the questions from the participants. Meanwhile, if any of you is having any questions, then we can keep on the session, sir. So we are having lot of questions.
Yes, sir. Pardon, please.
Sir, please.
Tech support team, where do we receive queries?
Queries has been received on our portal, sir. I am accessing the same and discussing, taking questions one by one, sir.
Okay, sir. So you are having access now, sir?
Yes, I have the access to the portal.
Okay, sir.
Yes. One of the question is, can company claim deductions under section 80G? So as per the section 80G is basically the deductions for the donations to the eligible institutes, and all assessee can claim benefit under that sections. So a company can obviously claim benefit under 80G. But one thing we need to keep in mind, that the company can claim deduction under 80G subject to the ceiling limits given under that sections. So it can be either 100% of the donation amount, it can be 50% of the donation amount, or subject to the qualifying limit. That need to be checked on case to case basis, sir. The next question is, can a non-resident Indian citizen also claim benefit of medical expenses under section 80D? The cost has been met out of the NRO account. So 80D benefit can be claimed by all the individuals and HUF irrespective of their residential status. Even a non-resident can claim benefit of 80D, sir. One question is there relating to the repayment of home loan. Two positions are given. Option 1, the loan is taken by his or her spouse. And option 2 is person is the guarantor in this loan. The person is paid the loan in whole installment. Person is also claiming the payment under ATC as a guarantor. Pair don't have any house in his or her name. So basically this question is on the point that the person who is taking the benefit is not the real or not the registered owner of the property. Either either his spouse has taken the loan or he is working as a guarantor. So as a part of section benefit of section 80C for the repayment of the home loan, the condition is assessee must have taken the loan. So here the case is different. The loan is taken by the spouse of the assessee. So as per the simple language of the section 80C, such transactions will not be covered under 80C and such spouse loan will not be eligible for 80C as the property is not in the name of the assessee. And if the assessee makes such kinds of claim, then it is obviously subject to lot of litigations. One question is, please explain section 80EEA with detailed example. 80EEA, as we discussed, is with respect to the loan taken for the residential property. So there are two sections, 80EE and 80EEA. Only difference is the timing of the sanction of the loan. If the loan is sanctioned into the financial year 16-17, 80EE is available, and if it is sanctioned from the year 2019 to 2022, then 80EA will be covered, and here the benefit is additional rupees 1,50,000 interest will be covered under this section. For example, a loan of rupees 1 crore is taken from the bank and interest rate is 7%. So for the full year the home loan interest amount is 7 lakh rupees, and out of this 7 lakh rupees we can take 2 lakh benefit under 24B house property head, and for the remaining 5 lakh rupees we can take benefit of rupees 1.5 lakh under 80EEA as a part of chapter 6A. So totality there can be interest home loan benefit of 3.5 lakhs maximum if the sanction is between 2019 to 2022. Next question is, I have no medical insurance. May I get benefit under 80D for expense incurred on my normal treatment? If so, what is maximum limit? So as we have discussed that for no medical cases, no medical insurance cases, the benefit is available for rupees 50,000. But the expense has to be incurred for the health of senior citizen assessee. If the assessee is not senior citizen, then probably there is no benefit under 80D for non-mediclaim cases. Next question is, premium on money back policy is eligible for deduction? So money back policies are basically a policy for which we need to make payment for 3, 4, 5 years and the premium will be returned back after some times. So technically these are policy for life of the assessee, these are life insurance policy. So benefit of money back policy is also eligible for ATC subject to overall ceiling limit of 1,50,000. Next question is asked is, life insurance premium paid for granddaughter minor is allowed as deduction ATC under section ATC or any other sections. So as we discussed in our presentation that ATC deductions is available if the premium is paid for the specified category of the assessee. That category includes the assessee, spouse, his dependent children. In your case, it is a granddaughter case. So granddaughter is not covered under the specified category. Therefore, grandfather cannot claim benefit of insurance premium paid for the granddaughter. It has to be for the specified category of persons only. Whether is the tuition fee had mentioned in the receipt of school for taking these deductions? Yes, the benefit of deduction under ATC is available for tuition fee and not for any other payment to the schools or universities. So we need to check the receipts which is being issued by the organizations, and we need to check that that payment is for tuition fee or something relating to the school and education tuition of the same. Certain other payments for development fee, donations, etc. are not covered under the ATC. What is the limit for interest on education loan for son postgraduate education in abroad? So under ATE, the interest loan benefit is up to rupees 1,50,000, subject to actual. Whether tuition fee is allowed to all the individuals in India, whether he is self-employed. Yes, tuition fee benefit under ATC is allowed for assessee himself as well as his dependent relatives, which are covered under the specified category. The payment for the tuition fee will be allowed under ATC for such persons. Another similar question is there. In case of construction / purchasing of property, registry is mandatory in the name of person claiming the deductions. As nowadays people purchase property in the name of wife and take loan in the name of husband. So husband will be eligible for the deductions. So all these cases are subject to litigations because the sections are very clear that the person should be making payment for his home loans. So if a loan is taken or property is taken in the name of wife and benefit is being claimed by husband, then we have to subject to litigations and judgments. Yes, next question is deductions of LIC paid is inclusive of GST. So whether that GST portion is also allowable under the ATC. Yes, we will get receipt for the entire amount of LIC premium, which will of course be inclusive of the GST, and benefit can be claimed for the, because it is based on the payment basis and person is not claiming any GST credit also. So whatever payment is being made for the LIC policy is eligible for the deductions. Does it cover home loan processing charges paid to the bank? This is a very interesting question. Many times the persons who is taking home loan from the bank is subject to the processing charges at the initial documentation phase, and those charges are also covered as a part of interest under the definition section of Income Tax Act, section 228. Interest covers the related expense in connection with the loan obligations. So processing charges can also be claimed under ATE. What are the deductions available for NRI? So most of the chapter 6A deductions are eligible to all the individuals HUF, irrespective of fact whether they are NRI or not. Next question is whether we will get the PPT. I can share the PPT with the organizers. Whether private tuition fee paid is eligible for ATC. So tuition fee paid for the schools and colleges whether private or public, will be eligible for ETC. Only thing is the schools must be registered under the respective category. Section 80D is the total limit is rupees 75,000 for self. As we have discussed, the 80D limit, primary limit is 25,000 for the self, spouse and children. And if self or spouse is including any senior citizen, then limit will be 50,000. An additional limit of 25,000 is available for the parents category, and if the parents are senior citizen, then that additional limit will be 50,000. So overall limit has to be seen on case to case basis depending on the factual metrics of the age of the specified category persons. Will the benefit of ATEEA be available only on the completion of the construction of the property and after its possessions? So benefit of ATEEA is available on payment basis. Whenever we are making payment of interest under ATEEA as per our sanctions terms and condition, the payment will be allowable because there is no condition attached with respect to the construction of the property or possession of the property. Section 80D medical expenditure and 80DDB medical treatment. Is there any difference between the two types of claims? Yes, 80D is for the medical insurance, whereas the 80DDB is for actual expense incurred for treatment of medical treatment. So insurance payment will be covered under 80D and actual expense to the hospital will be covered under 80DDB. Senior citizens having saving bank account, how much deductions can be claimed for interest income? So as we have seen section 80 TTA, the deductions for senior citizens under the saving bank account is exempt up to 50,000 rupees. For claiming deductions under section 80 EEA, whether holding of single house property is a must or individual can have multiple house properties. So earlier we are having section 80 EE where there was condition attached is that only one house property must be there, but no such condition is there in 80 EA. Can we carry forward current year losses in the new regimes? So as we have discussed that certain benefit has been taken away, so old carry forward losses and depreciations will now not be allowed to be carried forward under the new regimes. How to file form 10 IE for opting new regimes and when to file this form. So this form is required to be filed before filing of the return, number one. And for filing this form, we need to go to the official income tax website of the income tax department. We need to log in and then there is an option to file this form under the form category. What if home loan interest not taken as deduction while filing ITR? Can it be added to the cost of the property? Actually, cost of the property consists of the purchase price and related expense, number one. Then we have concept of cost of improvement. And for cost of improvement is defined to mean some cost which is incurred by assessee for improvement of the capital asset. So technically there is no provision whereby the interest expense can be added to the cost of property, but still we are having few judgments of the court which says that interest paid to the bankers can be added to the cost of property, but it is also subject to litigations and subject to judgments. cash limit of rupees 2000 under section 80G is for each donation or aggregate donation. This limit is for each payment. So a single payment cannot be more than rupees 2000 rupees in cash. Can section 80 TTA and TTB both be claimed by a senior citizen? The answer is no, because section 80 TTA is specifically excluding the senior citizen. When a specific section 80 TTB is there for senior citizen, therefore they cannot take benefit of rupees 10,000 under 80 TTA. Specific exclusion is there under the section itself. Life insurance policy premium paid for married daughter paid by father can be claimed by the father. So as we have studied in the definition of specified person, it includes the assessee, spouse of the assessee and dependent children. So once a daughter is married, we need to check whether she is dependent on her father or not, and the decision can be taken accordingly. Is the tuition fee deduction allowed for a private coaching tuition fees payment? So basically the deductions of tuition fee is available only for the payment made to schools, universities, colleges, etc. If there is some private coaching, private tuition, I hope that same will not be covered. What is the meaning of stamp duty for deduction 80 EEA? Stamp duty basically means the government stamp duty which is need to be paid at the time of registration of the property. Can you name few deductions under chapter 6A which are available for HUFs? So lot of deductions under chapter 6A are available for HUFs, as we have seen ATC, ATD, ATG, etc. GST levied on the premium eligible for deduction? Yes. Can you claim ATD deductions for domiciliary consultations and medicines which are not covered under the medical insurance scheme? So basically something which is not covered under the medical insurance scheme, we can claim amount up to rupees 5,000 under the head preventive medical care, not more than 5,000. Is any deductions allowed for interest on FD for senior citizens? So senior citizens are given benefits of 50,000 for interest on saving bank accounts. Husband has taken medical insurance including spouse under floater policy and claims deduction 80D deductions for premium paid. Can the spouse claim 80D deductions in her income tax return for the medical expense incurred for domiciliary consultants? I have already answered this. The expenses or payments which are not covered under the insurance policy can be claimed up to limit of 5,000 rupees under the preventive health care. Payment of arrear of life insurance premium relating to 10-year policy permissible under section 80C even if total premium exceeds 10,000 of the policy amount for that year. Overall premium does not exceed rupees 10%. So under this type of circumstances, the ban on the deductibility of the insurance premium is that the premium for the policy exceeds rupees 10% of the capital sum insured. Here we can argue and we can say that the premium is not exceeding 10% limit, but the limit has crossed only because of arrears of the premium. So probably deductions can be claimed, but still it will be subject to overall limit of 1,50,000. What is new under chapter 6A? Deductions. So as we discussed, the deductions relating to the interest payment of electric vehicles and all those benefits are new under the chapter. So sir, basically I have covered most of the questions which are available on this portal. Apart from this, any other questions from the participant we can take also, sir. Rishikesh ji.
Yes, sir. I guess there are no questions here which are visible right now. So we can wait for 1 minute. Otherwise, we can move towards concluding remarks.
No problem, sir.
So basically, it was a very wonderful session, sir.
Thank you, sir.
So shall we do concluding remarks, sir? Thank you very much, Sunil Malu, sir. Yes, yes. No, sir. Wait. We will do vote of thanks and then we can end the meeting. Thank you very much, Sunil Malu, sir, for your wonderful deliberations and interactive deliberations on deductions under Chapter 6. It is very important for the CA members, especially in this season when tax returns due dates are upcoming, and to brush it up, and because it is very important part of income tax returns, but little bit it is ignored in our practice. We focus more on capital gains and other things, and deductions are a little bit ignored. Because of you, it is revised, and now it is we are very confident. All the members will be really confident that we will be facing this season with very utmost confidence. I also thanks Direct Tax Committee of ICI, Chairman Sir C.V. Chitli Sir, and other dignitaries, and all other entire team of DTC for organizing this webinar, which will be very useful for all the members and participants. At the end, and very importantly, I thanks all the participants for joining this and making this webinar wonderful and successful. With this, I conclude this session, and thanks a lot once again, Sunil Malu, sir. Thank you very much.
Thank you, sir.
Now we can end the meeting.